Hello, and welcome to this pre-recorded webinar. Today we'll be discussing the local government pension scheme and the use of deferred debt agreements and debt spreading arrangements. I'm John Hubbleday, a director in the Pensions Covenant Advisory Team at BDO, and I'll be talking to Alex Omell, LGPS lead for BDO, and Gary Delderfield, a public sector pensions lawyer from Evershed, Sutherland. Today's webinar comes against the backdrop of the LGPS 2022 valuation, which comes at a time of significant macroeconomic uncertainty, which will affect the funding positions and ultimately the contributions employers will be asked to pay. Recent months have seen large increases in gilt yields, which have materially reduced cessation deficits for employers. Whilst the 2022 valuation will report on the funding position as at 31 March 2022, both funds and employers will be thinking about how changes in market conditions will have impacted funding levels since the valuation date and what this means from a risk perspective. Fortunately, the valuation is exactly the right time for funds and employers to discuss these kinds of matters. But before we get into the pros and cons of DDAs and DSAs, I'll hand over to Gary to provide an overview of what DDAs and DSAs are and why LGPS funds and employers may find these useful when managing cessation deficits.
Thanks, John. So I'm just going to give a bit of background to DDAs and DSAs when they came in and just some of the legal issues around both types of agreements. So DDAs, deferred debt agreements, and DSAs, debt spreading agreements, were introduced when the LGPS regulations were amended in September 2020 to introduce DDAs and DSAs for the first time. And what they were meant to do was provide greater flexibility to manage employer exits. And really, DDAs in particular provided new opportunities for employers who perhaps could not afford to leave the LGPS because of the size of their exit debts. I'll deal with debt spreading agreements first. So although there was a specific regulation introduced to allow these are not necessarily a new concept. In fact, many administering authorities would allow an exiting employer to pay their exit payment, their deficit, through a series of installments. This actually kind of formalized that power and sort of specifically kind of introduced it and made it explicit, although, as I say, kind of many funds were doing this before September 2020. The key thing with the DSA is that the exit payment gets crystallized, so that there is a deficit figure, and then that is just the agreement is effectively how long the installments will be paid over. There may be some complexities. So, for example, the fund may require some additional security, for example, to protect the fund during the installment period. But essentially, that's what it is. It's crystallizing the deficit and allowing it to be paid over a reasonable period of time. Turning to DDAs, the DDA, deferred debt agreement, is something different. This is an agreement with an exiting employer to defer their obligation to make an exit payment. So with the DSA, the exit payment gets crystallized. With the DDA, it gets deferred. Doesn't have to be paid up front. The LGPS liability will still remain on the employer's balance sheet. The important thing is that future accrual is stopped. So it basically allows that employer to limit their liabilities, to stop them getting any bigger because they're not accruing any more benefits, but without the downside of having to crystallize and pay the exit payment. So what happens with the DDA? The employer then continues to fund that deficit through their secondary contribution rates, effectively paying deficit only contributions to fund that deficit over a period of time. But it isn't a fixed figure. That the liabilities do get reassessed at every valuation during the term of the DDA. So the liabilities can go up or go down at the next valuation, and the contribution rates won't be fixed during the period of the DDA. But the end aim is, by the end of the agreed term, the employer would hopefully have paid that deficit off through its secondary contribution rates. So legally, various conditions that you must have in place for a DDA. The last active member must have left the scheme. I'm going to possibly come back on that point a little bit later. Funding, the funding strategy statement of the fund must set out the fund's policy on deferred debt agreements. And before entering into a DDA, the administering authority has to consult with the exiting employer, which obviously this will normally be driven by the exiting employer. And the administering authority must also have regard to the views of its appointed actuary. I think the important thing with a DDA is this is an administering authority discretion. An administering authority does not have to enter into a DDA. It's a discretion as to whether it agrees to do so or not. Therefore, an employer cannot demand a DDA. However, a DDA may result in better outcomes for both parties, and particularly from a fund perspective. It will limit the liabilities of an employer from getting any bigger, and potentially may result in better recovery for the fund versus crystallizing an exit payment that an employer can't pay and then forcing an employee into insolvency with limited recovery for the fund. So the DDAs can result in better outcomes both for fund and employer in the right circumstances, which Alex will come on and talk about shortly. So with the DDAs, as I say, the employer still remains on the hook to meet all the normal requirements of being a scheme employer within the fund, except just the obligation to pay the primary rate of contributions for future accrual drops because there is no future accrual, but all of the other normal scheme employer duties and responsibilities will continue to apply during the term of the DDA. As I say, the employer has to pay the secondary rate of contributions. The main thing, I suppose, with the DDA, the administering authority needs to be comfortable about the financial covenant of the employer and that it can actually afford those secondary contributions over the term of the DDA. Therefore, one of the things that we're seeing on the DDAs that we've been negotiating is in some cases requirements to have security, again, to protect the fund in the event of default during that period or the body becoming insolvent. So we're seeing things like bonds, potential parent company guarantees, or charges over assets such as property being put in place as a backup, as security for the DDAs. Other requirement is that the DDA has got to be for an initial fixed term. What we're seeing is sort of typically somewhere between 10 to 15 years, usually in line with the fund's sort of deficit recovery period. So although you have to have an initial fixed term, that the term could potentially be extended at the end of that. So, it could be, say, a 10-year, could then potentially be extended by a further period once you reach that expiry date, but the initial DDA must have a fixed end date. And finally, just on the legals, there are various triggers in which the DDA must terminate. So obviously, other than the expiry of the fixed term, other notable ones would be if there is a takeover, amalgamation, insolvency, winding up, or liquidation of the body. That will trigger termination unless the administering authority is satisfied that the body can still continue. That's probably only really going to be relevant in the event of a takeover or an amalgamation. And one of the other key termination triggers that is quite controversial is if the administering authority decides that the employer's ability to meet the contributions has weakened materially or is likely to weaken materially in the next 12 months, that could also potentially trigger termination of a DDA, which is often a concern on the employer side as to in what circumstances would the administering authority come to that conclusion. So when the agreement does come to an end for whatever trigger causes that, then you just then fall back to the standard position. So with an exiting employer, there would then be an exit valuation undertaken of the assets and liabilities of the employer at the point the DDA terminates, and then there will either be a surplus or a deficit, or hopefully actually the body will be fully funded, and then that will be dealt with in the normal way. So from a legal perspective, that's how the DDA will operate. I'll hand back to Alex now.
Thanks, Gary, for that useful insight into the legal considerations of DDAs and DSAs. So at this point, I'll be going through some of the pros and cons of DDAs and DSAs, and also some of the wider employer covenant considerations in the new exit flexibilities. Now, there are some unique pros and cons associated with both DDAs and DSAs, and the best arrangement for either funds or employers will vary on a case-by-case basis. A DDA may be particularly attractive to an employer who is looking to keep expected cash costs down, as the fund's investment returns will be expected to do much of the heavy lifting in repaying the deficit. However, it's worth noting that if the fund's investments underperform, then higher employer contributions may be required to bridge the funding deficit. This can put pressure on the employer's cash flow, potentially at a time when cash is in short supply, and so an employer should consider whether it can afford to pay higher contributions in a downside scenario. From a fund's perspective, the preferred option is likely to be a DSA, as this does not rely on expected future investment returns and will likely result in higher cash costs being paid into the fund. However, a DSA still leaves the fund exposed to the covenant risk of the employer and the risk that the employer becomes insolvent before all DSA contributions have been paid. As the employer covenant can change quickly, it's important that both funds and employers agree an ongoing monitoring framework so that both parties are clear on what information needs to be provided and when. This could be incorporated as a provision in a DDA or a DSA agreement. Now, when an employer and a fund discuss the option of implementing either a DDA or a DSA, a key feature of the conversation will be focused on the topic of affordability, both from the perspective of what the employer believes it can afford to pay and from the perspective of what the fund believes the employer can pay. And these views are not always one and the same. Assessing affordability can be complicated, and an important first step is knowing what information to ask for. It's important to assess the employer's current and forecast financial position. Management accounts should provide an insight to the employer's current trading and cash flow, including the split between any core and discretionary operations, which could potentially be reduced without compromising on the core service which the employer provides. We often see this as an important element of assessing the affordability of charities. This will help the fund and the employer to assess where value is being generated in the organisation, including where potential pressures could arise if key contracts or revenue streams are lost in the future. The employer's forecast will be built on assumptions reflecting its operating model and market position. We think that it's important that any assessment of the employer's forecast includes an understanding of those assumptions so any growth or decline in revenue or improvement or reduction in surplus is clearly understood in the context of the cash available to the scheme. Other assessment criteria could include an assessment of the employer's reserve policy, a review of any available debt facilities, including when the next refinancing is due, together with an assessment of unencumbered assets that could be leveraged for future capital. Now, in reviewing this kind of information, it's important that a proposal on contribution affordability should be employer-led, as the employer will have access to all the relevant information to make an informed proposal on affordability. However, of course, the fund can challenge the information that's been provided based on their own interpretation of the employer's current and forecast financial position and their perception of the risk in the employer covenant. So when assessing covenant risks, it's important to take a proportionate approach when engaging with any employer. The starting point should be to assess the amount of free cash available, as this will give both parties a sense of how much cash is available after the payment of essential expenditure, and which can be calculated by taking cash in operations, less capex, working capital, and other investment obligations. Although a more detailed analysis may be needed if the covenant is already weak and there are concerns that scheme contributions may result in further financial distress. Now on this slide, you can see that with a DSA, contributions remain stable over the course of the funding term. This is a key feature of a DSA agreement, which Gary explained earlier. And all other things being equal, we would also expect contributions under a DSA to cost more than a DDA, as the employer will not share in the potential investment upside of the fund. Under a DDA, employer contributions can fluctuate, and it's important for both funds and employers to understand the quantum of those fluctuations in terms of revised contribution payments and whether an employer could afford to pay higher contributions following a downside scenario. Ultimately, determining the amount of cash that's available for the scheme and how much cash should be retained for the employer's operations includes an element of judgment, which will depend on the nature of the employer's operations, their sector, their project and CapEx pipeline, together with an appraisal of the potential value that future investment in the business could bring to the scheme. For example, could reduced contributions in the short term lead to increased investment in the employer and consequently increased contributions to the scheme in the future? Both the employer and the fund may decide to procure external covenant and legal advice when negotiating on matters of covenant and contribution affordability, as any agreement reached will have long-lasting implications for both parties. And at this point, I will hand back to Gary to discuss some of the practicalities of DDAs and DSAs.
Thanks, Alex. So I suppose I'd start in terms of practicalities by saying, whilst several multiple DDAs have been negotiated, very few actually to date have been signed and sealed, so to speak. One of the main reasons for that is, as John alluded to at the start of the webinar, market conditions have actually meant that many employers that thought they were facing unaffordable deficits may now actually be able to afford to pay their exit payments, or potentially, dare I say it, may even be looking at surpluses. So a number of DDAs have been negotiated, but many are currently on hold, kind of pending those exit valuation results. One of the things I would say is that as a main practical point, they do take a lot longer to negotiate than has perhaps been expected, mainly because there are so many factors that have to be taken into account when negotiating the DDA. Financial covenant assessment needs to be done. There may be changes. We've seen one employer, for example, kind of amalgamate during a negotiation process. Funding bases have to be agreed. Affordability of contributions. Security can add quite a lot of complexity into a negotiation if security is being provided to back up the DDA, and negotiation around the termination triggers. So all of those factors have tended to mean that the DDAs have taken quite a lot longer to negotiate than perhaps parties had initially anticipated. One of the points just to pick up on, I mentioned this earlier, one of the requirements for a DDA is that the employer's got to have no active members left in the scheme. We think that is a drafting error. We think it should be no active members left in the fund that they are participating in. We have seen a couple of employers exiting that have admission agreements with other LGPS pension funds. Therefore, on the face of the regulations, that would preclude them, because they've got active members in other funds, that would preclude them having a DDA when they exit one fund. We did contact DLUC about this, and we were told that that is actually a drafting error in the regulations, and the intention is that should be a reference to no active members left in the fund in which it participates rather than in the wider national scheme. But that has not yet been corrected. But we're told the intention is it's no active members in the fund, not necessarily in the wider scheme. And again, just last couple of points. What documents do you actually need? Well, a DDA is a separate legal agreement, so you need a separate legal agreement when you're entering into a DDA. That would replace any existing participation documents like admission agreements, which would have come to an end. They get replaced by a new legal contract between the administering authority and the exiting employer. DSA, a debt spreading agreement, on the other hand, that's simply a revision to a rates and adjustment certificate setting out the instalments for the exit plan. So you don't technically need a separate legal agreement for a DSA. You just have a revised rates and adjustment certificate, but they could well be additional background documents like security documents that still need to be negotiated that may be backing up a DSA. So there are just a few practical points. Now back to Alex.
Thanks, Gary. Okay, so turning now to some illustrative examples. We created two hypothetical scenarios where an employer could potentially be a candidate for either a DDA or a DSA. Now, in this first example, an employer, a charity, has exited the fund with a £15 million cessation deficit. The employer's net assets, excluding the LGPS deficit, is £7 million. Cash on hand is £0.5 million. The employer also has a bank loan which has been fully drawn and secured on the charity's property. The charity has said that immediate repayment of the cessation deficit is unaffordable for the business and would cause the charity to become insolvent. The charity requests that the fund consider implementing a DDA. The employer provides forecasts for the next 3 years in support of this, and these forecasts show that the charity expects to incur a significant operating deficit over the next year. But through a restructuring of the organisation, year 2 should see a break-even budget and then a return to surplus in year 3. The charity has said that they cannot afford to pay any more employer contributions over the level that they're currently paying to the fund, and may even need to request a reduction, subject to the charity's future financial performance and the success of their planned restructuring program. The charity has emphasised that they need time to rebuild their cash reserves following recent trading volatility in order to ensure that the organisation is on a sustainable financial footing. So is this employer a good candidate for a DDA? Well, based on the information the charity provided, their financial position is weak relative to the size of the cessation deficit. Immediate repayment of the cessation deficit is not possible without triggering an insolvency event. Whilst the fund may see a sizable return on deficit, even as an unsecured creditor, by demanding immediate repayment and forcing an insolvency event, there would likely be a negative PR response to the fund in doing this, especially as the employer is a charity. The fund still has a choice of whether to offer a DDA or a DSA, despite the employer's preference for a DDA. Whilst the DSA would give the fund and the employer certainty over the contributions due, it is unlikely that the employer will be generating sufficient cash to pay off the deficit in a reasonable timeframe. Unless the fund was prepared to commit to a significantly long repayment period for a DSA, then the DDA may be the more sensible option. In this next scenario, we consider whether an employer would be a good candidate for a DSA. The employer is a social housing association and has a cessation deficit of 25 million. The employer's net assets, excluding the cessation deficit, are 300 million. Cash on hand is 50 million. The employer has been generating consistent surpluses from operations, which has led to an increase in their cash position. As this employer is a social housing association, they also have a mixture of facilities, such as loans and bonds, etc., to help drive their higher intensity CapEx program. So is this employer a good candidate for a DSA? Well, based on the information that's been provided, it's clear that the employer is financially strong relative to the size of the cessation deficit. Whilst the employer could arguably pay for the cessation deficit through their existing cash reserves, the employer has requested they be considered for a DSA. The employer maintains that their cash position needs to be retained to service their relatively high levels of debt, and also to absorb fluctuations in sales demand or increases to expenditure, such as through supply chain failures. Whilst the fund could push back on these arguments, the employer presents a relatively low degree of covenant risk in the short to medium term, so it would be pragmatic for the fund to agree to a DSA. However, the fund could mitigate the risk in the DSA by keeping the payment term as short as possible, i.e. no longer than 10 years, and by potentially taking security from the employer, such as a charge over assets, a bond, or a parent company guarantee. And at this point, I will hand back to John for the final part of the webinar.
Thank you, Alex. Thank you, Gary. There's clearly a lot to think about when considering DDAs and DSAs, and importantly, there appears to be a lot of flexibility available in implementing them. So I've got a couple of questions for Gary and Alex. Firstly, for Gary, can funds and employers amend these agreements after they've been implemented? For instance, for changes in affordability or for any other unforeseen events?
So yes, you can amend a DDA as long as you put a power of amendment into the contract. So that will be kind of usually a standard boilerplate provision, which would allow you to go back and change the DDA. In terms of changing contributions, then they're set at each valuation during the term of the DDA. So that would depend on whether there's an ability under the rates and adjustment certificate to go back and renegotiate a change in rates. But yeah, certainly in terms of changing the actual provisions within the agreement, that will be done through the power of amendment in the document.
Great, thank you. Alex, a question for you. Should employers and funds monitor the cessation deficit during the period of the DDA? Is there any benefit in that for them?
Yeah, that's a great question. I think monitoring the cessation deficit is important for a couple of different reasons. Firstly, proactive monitoring will provide both employers and funds with confidence that the contributions being paid are sufficient to reach full funding at the end of the term. Obviously, if they're not, then it's important to discuss whether the employer covenant is strong enough to pay increased contributions to the fund. And evidence for that could be provided in the form of management accounts, forecasts, and details of any material cash outflows that might impact contributions to the fund. However, another reason why monitoring the cessation deficit is important is that it will allow funds to capture movements in the assets and liabilities, which might reduce or increase the amount of the cessation deficit. We've seen over the last few months how there have been material swings in gilt yields, which have been driven by fiscal and monetary policies. And a net effect of that is that many employers will see reduced cessation deficits in the LGPS. Now, if an employer has a materially reduced cessation deficit, then it would be pragmatic, I think, for them to pay off the cessation deficit by way of an early settlement. But of course, whether or not that's possible will depend on the provision that's been written into the DDA at the point of commencement.
Great, thank you, Alex. Gary, I'll come back to you. Can scheduled bodies enter a DDA or a DSA?
Yes, they can. Yeah. So the regs just refer to an exiting scheme employer. I mean, all the ones that I've been dealing with to date, I think, have all been admission bodies. I guess they're the type of employer that exits the fund, most commonly. But yeah, I mean, in theory, we've seen actually had a Part 1 scheme employer exit over the summer, and Part 2 subsidiary companies you do see exiting the scheme from time to time. So yes, in theory, a DDA could be with a Part 1, Part 2 body, scheduled body, or an admission body. Doesn't matter.
Great, thanks, Gary. I've got one final question for Alex. Can you have a DDA for an employer that has historically exited the fund?
Yes, so for historic employers who have left the scheme with an outstanding cessation deficit, we are of the opinion that the LGPS regulations do allow for the recovery of outstanding liabilities from historic employers, which of course could be affected via a DDA. However, there are important legal and covenant considerations when engaging with historic employers. From a covenant perspective, we would suggest that funds review the covenant of historic employers in the same detailed manner that would take place for other employers who have more recently left the fund. That is, evidence of the employer's financial position should be provided to evidence whether it has financial strength in order to enter into a DDA. Other factors, such as whether or not the employer has available security to offset the covenant risk of entering into a DDA, should ultimately be considered. But I think it's also worth noting that this is a complex topic and one that might be discussed in more detail on another webinar, which may, of course, be coming in the future. So please do keep your eyes open for that. Over to you, John.
Great, thanks, Alex. So in summary, both DDAs and DSAs offer useful flexibilities for both funds and employers when managing covenant and funding risks, and ultimately obtaining improved outcomes for both. It's important that consideration should be given to both the legal and the covenant dynamics of DDAs and DSAs, which can vary depending on the employer's sector, legal status, and financial position. I'm expecting many employers will want to consider whether entering a DDA or a DSA will be the right thing for them to do following the 2022 valuation. Should you wish to discuss this or any other aspect of today's webinar with our speakers, then please get in touch. Finally, I'd like to thank Gary and Alex for their insight and for you for watching this pre-recorded webinar. Thank you.